From this episode onwards, we will get into the fundamental concepts of stock markets. I have intentionally avoided the financial jargons and restricted myself to level 1 learnings. This should be a good starting point for y'all, and I will also be giving you a good macro perspective of the fundamental concepts related to stock markets. So let's start with the basics. All companies need money to run their business. To expand and grow their business, the company needs money. They may decide to either borrow money from banks or other institutions, get private equity people to invest in their company like startups do, but at a bigger level. Invite normal people like you and me to put some money in their company. This last process is called an IPO, which I will explain in the next part. Through this process, we become part owners of the company and share the profit or loss, whatever the outcome is. The certificate or a document we get in return for giving them money is called shares or equity. A company may typically have 1 million to 100 million in the company. I can buy any number I wish from an agency called the stock exchange. Even if I own one share, I become the co-owner or shareholder of that company. A stock exchange is like a marketplace. Imagine like an e-commerce platform like Amazon, where buyers and sellers meet or are listed to buy and sell shares. All buying and selling activities has to happen from this marketplace called the stock exchange. The shares are then transferred into a virtual account for storing these shares. This is just like a bank account, but with details of names of companies and the number of shares you own. Popular Indian stock exchanges are the NSE, which is the National Stock Exchange, and BSE, which is the Bombay Stock Exchange. Popular US stock exchanges are Dow Jones, NASDAQ, and the NYSE, which is the New York Stock Exchange. Every country has their own stock exchanges. Popular Indian stock exchanges are NSE, which is the National Stock Exchange, and BSE, which is the Bombay Stock Exchange. Popular US stock exchanges are Dow Jones, NASDAQ, and the NYSE, which is the New York Stock Exchange. Every country has their own stock exchanges, and all companies that have ever had an IPO in that country, their shares and the major owners of shares and their details will be available with the stock exchange. Once these listed companies make profits, the management will decide to distribute, or we can say share these profits with the shareholders, the ones that own the shares. The amount received through this share is called dividends. It is decided on the basis of how much return to give per share. It could be 10 rupees per share. So if I own 100 shares, I get 1000 rupees as dividends. When a company issues the shares, there is an IPO listing price. They may decide to sell the share at rupees 50 during the IPO. If I'm interested, I have to pay this price. After that, if the price goes up or down, the company is not responsible. Now I am the shareholder, the co-owner of the company. Investors typically buy shares only with the expectation that its price will keep increasing over the years. If the company is making good profits, the one share that I bought for 50 rupees could become 500 rupees or even 5,000 rupees or even higher than that over a longer period of time, say 10 to 30 years. This is your return on investment. As discussed while making the IPO, the company decides the price of a share. You and I buy the share at this price. After that, all shares are traded only through the exchange. Now, buyers and sellers both are on the stock exchange platform and kind of bid for the price. From now on, the IPO price has no relevance. The price could go higher or lower depending on the demand and supply. If there are too many buyers, the price will go up. If there are too many sellers, the price will go down. At any given time, thousands of buyers and sellers keep bidding the price. Imagine this to be a virtual auction happening on the platform. Let's take an example of a railway platform. People boarding and getting off trains. This keeps happening. This keeps the price going up and down by every second, every minute, every day, weeks, months, and probably even years. If the company is doing very good business, it has a higher number of buyers and very few sellers. This could start pushing the price higher and higher each day, eventually giving you higher returns on your investment. You can decide when to sell the share and make your profits accordingly. You do not need anyone's permission or approval for this. The opposite is also true. That is, if the company does lose share price, that will fall, you will lose the value of your investment and make a loss for yourself. I guess this should give you a fair idea about the stock market and its operations at a broad level.